The following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, everyone. Basil Chapman sitting in for John Logan. John is traveling, and it was my pleasure to be able to sit in and be here for him. Usually I'm at 11 o'clock till noon Eastern time. I have the Tiger Technicians Hour. My service, my daily service is called the Opening Call. And for subscribers, I hope to have the follow-up to that webinar I had about a month ago, less than a month ago, a paper that I'm doing, and I hope to have that done over the weekend. But since it has to be sent out through TFNN, that could only happen by Monday, maybe Tuesday at the latest. I really do hope to get it out. It's a little longer than I anticipated because there's a lot to talk about. I want to talk about the commodities. I want to talk about the impact of the dollar, a whole bunch of things like that. So I also wanted to use charts and not just anecdotal data, but the empirical data that I could pick up to be able to confirm what I'm looking at for my overview for what should happen in 2015. We'll see, you know, not everybody gets everything right, and you do the very best you can with the particular techniques and the history that you know from previously, and you know that history repeats. And so let's look at the market right now. The futures, the E-minis are down 3 at 2061. A very impressive rally yesterday. Let me show you something a little clearer. Actually, maybe it's even better. Let me just go to this so that I can, for those of you who are new to my concept, very simple concept. Let me slide this across here. It's a very simple concept. You try to identify the lowest, most obvious low bar. I mean, this is the way I like to phrase it. In reality, sometimes you can get a low bar that is part of the structure of what you're looking at, so that you know it isn't obvious, but the closer you look, you say, that is the most identifiable low bar that I can use for my Chapman wave count to the upside. What is the count? Very simply put, it is going from the most obvious lowest low bar to merely 4 successively higher peaks, and I'll label them alphabetically in uppercase A, B, C, D. The alphabet goes just like on the piano, where you can, in music, you can go A, B, C, D, E, F, G, but there is no H. Good morning to GL and the Den and J. But it recycles after G. It goes back to A. However, when you're looking at the Chapman wave, what happens at the 4th highest peak at peak D, that is really important. Why? Because it's at peak D, just like you can see on this particular chart of the 15-minute E-minis some time back. I'm just using it as an example. From a down move, you go peak A, 1 penny, in this case, 1.25-cent tick. Above A starts leg B. It's called leg B until it makes the little inverted V-shaped pattern that makes a peak. Look how many words I have to use. This drives me absolutely nuts. Look how many words in all these years. I wonder how many words I've used just to describe the Chapman wave buy signal to buy mode, with the implication that a buy mode should go to at least D. When you can look at one picture and say, oh, there it is, A, B, C, D. Even saying it takes longer than looking at it. And at D, in this case, I put a down arrow, and look at that down arrow that it coincided with the huge move to the downside. So I wanted to get that out the way. Now let me move this away, and you can see exactly what I'm talking about in real life. Why? Sometimes you can go a little higher than a D. You can go to an E, and as I say, E, F, and even a G. When you get to a G, you want to look to see if you haven't recycled, if you haven't missed something. Why? Because I call G's rare. most of the time you don't go. You go to an F as the maximum. Just like in this weekly chart of the E-mini, look at that peak F. I got the down arrow at D because the stochastic went below 80%. The price went for 2 bars underneath the 9-period moving average, that black line in the weekly chart. This is the daily, this is the weekly, this is the 120-minute chart. This is the way I've got it right now. Whenever I show my subscribers every single morning, I show them this. I don't give buy signals, or I don't give recommendations on the E-minis. That would be almost like another service. I just don't have time for that. But I do show them exactly what we're looking at. And in this particular instance, the weekly failed at C. It didn't fail. It stopped at C. Before, when it went to the down arrow at peak D, the week of the 25th of July, it plummeted under the 9-period moving average. The MACD went negative for a moment, and then started something that I call the double camel hump. You know, there are some camels that have 2 humps, not one. I'm very visual. I came to stock market charting via being a graphic designer once, so I'm very visual. You see the way right here that fast-moving average of the MACD in the daily was rallying very sharply. That is very important. You see the way there was a divergence between the top there and that retry for the 11775 high in the daily, and the stochastic was starting to pull back. That's a divergence. Well, look what happened here with that double camel hump. The second time that the price ran up to E/A, because it can have an alternate count, F/B, the MACD and stochastic were not confirming, and that is just a great clue. When the stochastic only goes up for a certain period above the 80% line and then breaks below it, that's a heads up to say, whoops, failure coming, watch out. That's exactly what happened. So the down arrow is here, but the real top was in that inverted little caret right there, the little inverted V, and that's where the market pulled back sharply. You got that October, we were, thankfully, I recognized it quite quickly, and we went short, and we managed to cover on that October 15th turnaround day. The next day we covered. Now we've got, there's no other way to count it. Peak A, peak B, peak C. I'm missing the D. In the Dow, INDU, we got that D. Everything's in place in the Dow for a peak D sell signal to sell mode in the daily, and the chance that there could be a sell signal in the weekly. I like all the little ducks to be lined up. We're missing the one most important little duck, the little ducky, in the S&P. The QQQs have, in fact, made an alternate count EB. As long as I've got an alternate count, I could have the double camel hump right there. Such a silly thing, double camel hump. The H to M pattern in the lowercase h to lowercase m in the slow stochastic and the MACD. Look at the way in the QQQ weekly, this is the iShares, the power shares of the NDX 100. Look how you're failing to confirm the rally. I had people asking me, have we recycled to a brand new, is this going to go to leg D in the S&P? Is this going to go higher in the overall index? And I said, I don't think so. You can get a really good rally in the IWM. Alex called yesterday, we discussed this, and he was long from the exact October 15th low. Congratulations, that's fantastic. And I said, no. Let that go. You've got one of the strongest indexes, the iShares of the Russell 2000. Look at that. Look at the weekly chart. It's barely budging. And you've got a very nice rally. I'm suspicious of this. I think there's going to be a V-shaped pattern, and it fails. I think this is a digestive phase. All of a sudden, you've got Intel, the SMHs, which were absolutely fabulous. Look at this, the SMHs, peak F at 58.47. This is the semiconductor index. Alternate count F/B in the weekly. Same thing here in the MACD, failing to confirm with a higher high, the high that was made at 56.54 back in December, the week of December the 12th, in the weekly chart of the SMHs. And look, here's the 120-minute chart. We're underneath the 200-period moving average. We did make a left side, right side price arch price time match with the Chapman wave inside wedge there. But look at the monthly chart. The monthly chart is suggesting that the 9-period exponential moving average of 52.89 is going to give us all the clues we need as the stochastic is starting to fail and the on-balance volume is not really confirming this price move to the upside in the market vectors semiconductor index. And what does it have? It has Intel, Taiwan Semiconductors, ASML, MU is Micron, Texas Instrument, Applied Materials, Broadcom, just a huge ADI, AVG, CLAC, LRCX, Xilinx, Altera, just it goes on and on and on. Famous names here, Cree. And at the same time, it's saying there is nothing wrong yet in the price movement, even though this is a red candle. It made a new all-time high. Let me say all-time high. Oh, no, it hasn't made an all-time high. Why? Oh, I love this when the ETFs, look at this. This is the semiconductor market vectors ETF came out when? They always do this. May of 2000. It didn't even have a year to go before it made its all-time high in leg A at 100.20. We are way below that. The QQQs have gotten back almost to the 120, I believe, or 121 all-time high. The high so far has been 108.94, and that's really interesting. 109.42. So here's the QQQ monthly walking the 9-period exponential moving average. You got the semiconductor index walking the 9-period exponential moving average, and that's 5280 area is going to be really critical going into May. I'm still thinking that March into April is this digestive phase. Even if we had to make a new all-time high in one or two of the indexes, I think this is a digestive phase. We've had a spectacular move. We've had a 6-year run. Usually on anniversary periods, you've got to be a little bit careful. And I think that this is the period to be somewhat careful here. And the XLF had an absolutely tremendous move. Look at this. Nice move. It wasn't a gap, an island gap to the upside, because the high of the 10th was 24.14 and the low of the 12th was 24.14. If it was 24.15, there'd be an island reversal here. Hey, talk about island reversals. Look at this. Island reversal in the TLT. TLT is the Lehman 20-year T-bond fund. The TBT is the opposite. It's the inverse, and it made an island reversal to the downside. That's going to make this trend line resistance right there at 45.28-ish. Very important. A break above that says, woohoo, watch out, TLT's going to be coming down. And then watch this chart here, which is the yields, my weekly triple yield chart. I'll talk about that when we get back. Basil Chapman sitting in for John Logan. Very difficult to do, but I'm doing it, and I'll be right back.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Think or Swim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk, charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, everyone. I'm back. Basil Chapman sitting in for John Logan. My show is usually 11 o'clock till noon, so it's my pleasure to be here at this time, and while John's traveling, and I'm pretty sure he'll be back Monday. And so what I'm doing is whenever I host a particular, I'm a guest host on a particular show, I try to get a little bit into using my techniques, trying to relate it to what I hear when I listen to their shows. We've got very impressive hosts here at TFNN. So what I thought would be very nice is if I used one of the techniques I developed a long time ago. I hardly ever use it because I have other techniques which I find are giving the same kind of information. And every once in a while, like every 2 weeks on a Sunday evening, I'll just sit there and I'll scan using this just to see if what I'm looking at is good. Look at these cluster patterns. This is a technique that I developed using the MACD and the stochastic. First of all, you see the green line here. This is a crossover that gives you a trend. And on the way down, you see the little bit of red there. So this is saying the E-mini 60-minute chart is showing a cluster formation. When I get a whole bunch of, a whole cluster of price points that are showing at a certain level, Look, 2069.43. This doesn't know that it's the futures and only trades in 25-cent increments. Doesn't matter. 2070.32, 2069.32, 2068.22. It says to me that is a very strong area of resistance. You know how John has these these same kind of dashed lines across all these dotted lines? And he talks about it as being a level that you've got to watch because it's a level of support and resistance, and it's a red or it's green. In this particular case, the cluster at the top says, be careful. Here we've got a price of 2058.95. What was the low so far in the 60-minute chart? 2058.25. So this I found, and it just amazes me always, how accurate this particular conglomeration of figures can be. But as I say, I'm going to go back now that I've been using it for a few days again. I'm going to start using it a lot more. Let me change it to a different time frame. So we'll go to let's go to the 10-minute. See, the 10-minute says it went right through the support of 2059.55, but there's a chance that you're going to come back to retest the 2059.50 area. And it said right at the top, at 2068.75 and 2069.05, there was this cluster pattern right there. And it actually goes back for a while. What's fascinating about this is that years ago, I'm talking about decades ago, when I used to hand chart, I used to use a closing price fixed point. Well, I would get to that point and I would draw the line with a ruler. Sometimes I'd use a 15-inch ruler on this graph paper, and the line would go on, and I'd forget about it because the price went in a different direction. Like 2 months later, we're suddenly approaching that very line. It amazes me how diagonal. I can understand horizontal lines. What really impresses me is when you get diagonal lines like this that become resistance or support. And that's why if you look at this, you'll see if I use this, we're going to go to a caller right now. If we go to this particular price point right there, look at that. We held that trend line. How did that trend line know that that trend line was in place? I'll try to talk about that a little later on. I'll talk about it in Technical Friday in my show. Right now we're going to go to John in Philly. John in Philly, how are you?
Good morning, Basil. Listen, you are a trooper, and thank you so much for doing not only your show, but taking over Steve's while he's on vacation.
This is John's, yes. Actually, sometimes I do that, but right now I'm doing John as he's in transit. Hopefully he has a safe flight.
I'm
yes,
sorry, John Logan, not Steve Rhodes. You're absolutely right. My mistake, yes.
That's no problem.
Basil, you spoke on your intro about ducks in a row. I'm going to give you a choice between mallards and golden eyes.
I'm not that conversant with it. I have heard of the mallards, but I have not heard of the golden eyes. All right. So, yes, question is.
I wanted to ask you right about the E-mini S&P futures that you're speaking of now and the NASDAQ Composite Index. First to the ES minis.
Yes. Let's get the question, and then we'll have a break. Your question is?
The 9-day EMA.
Yes. Okay, we can discuss that as soon as we get back. We've got John and Philly on the line and Basil Chapman right here in the guest host seat. I'll be right back. And we've got a report coming out, I guess. The E-minis are down 475. We'll be back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, everyone. We're back. Basil Chapman sitting in for John Logan, and we're on with John in Philly. So the 9-period exponential moving average is your question in the S&P weekly or daily chart?
Yes, daily. Let me elaborate what I'm looking into. The stock market peaked March 2nd in several indices.
Yep.
Declined 7 trading days into Wednesday. Bounced yesterday nicely. Question that I'm entertaining is, has a trend reversed, at least for the near term? And if it has, is this bounce liable to run into resistance that's shortable against the now declining 9-day EMA? And also, when one looks at the cash, the underlying cash index, the S&P 500 cash, between Monday's close and Tuesday's open, there was a gap down. And there is an open gap that we're running up into where also lies that 9-day EMA. I'd like your thoughts as to whether that is reliable resistance to short against.
So let me show you something here as you're talking about it, because I'm going to introduce another chart, and it is the S&P Cash 120-minute chart. And there you can see that there was an arch formation. I haven't quite completed this one. I don't want to take time now to do it, other than to say that the left side low bar that I would have used, actually I will do this, look. I'm just going to go like this. From there to peak D right there, and then I'm going to go make that green so that you know that's the up move, and then the exact time match to the downside in pink dashed line, just so that it doesn't get in the way. Look at this right there. I love this. This is what's called the plumb line. Actually, it's one bar. Yep, it's one bar off. It should be one bar to the right. So if I use this peak D in the S&P as a plumb line, that is a midpoint. If anybody knows about building, if you're looking to draw a straight line down against, say, a wall, because you're going to do something or measure to put a picture on or whatever, you want to get the exact vertical line, so you use a plumb line. Well, this plumb line goes to the low in the 120-minute chart at 3:30 in the afternoon of the 9th of February, at 2041.88, goes to a high of 2119.59 at 15:30, same time, 3:30 on the 25th of February, turns around. Now, this is what I talk about a lot. I talk about, unless there's a crash phase, when you hear people say that the left side is taken out in way quicker time than the on the right side, that's only when you're in crash mode. Under every other condition, the normality is, although we don't feel it, and one of the reasons being that when the market starts to really tank and go down sharply, fear comes into mind and people sell very quickly. That's the difference. And on the upside, I've searched for a word for years. Crash is just so all-encompassing in the market. You just know that doesn't sound good. So I've looked for the exact opposite on the upside. Look at these bars. Look at this powerful takeoff on the, as you identified, on the 2nd of February. What do you call that? What do you call the next bar? Hey, what's the opposite of crash? The only thing I've come up with is rocket ship. That's the only way you can explain it. And even that doesn't show the euphoria, which is the exact opposite of crash. So I'm still searching for that word, but in the meantime, for a while now, I use the word rocket ship. So what do you compare the down move on the 10th of March that showed very sharp downside potential, and yet if I count the bars to the 2014 low, 2041 low in the daily chart of the 9th of February, I go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 bars up to 2119.59, the all-time high. And then it comes down 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And yesterday was the 11th bar. It came down one bar shorter, and it went a tad lower. It went to 2039.69. So I just wanted to explain to you that because yesterday was a really good move to the upside, it wasn't anything like the down move, and yet in the marketplace there was some sense of euphoria going up. In fact, there was more euphoria yesterday than there was negativity, because it was the second huge day to the downside. The 9th had another big day, had a very sharp down day in the S&P. So by the 11th, you were kind of saying, oh, geez, just another one of those things. But the move yesterday, especially since it took the XLF, the financials up very nicely, had to my way of thinking, a touch of euphoria. That tells me that I've got to look very closely at the MACD, the moving average convergence divergence. Look how wide that is. Look how much time it would take to get that green line, what I call the fast moving average, the 9-period differential, to even touch the red line. It's going to take at least another, in the S&P, another 20 to 30 points just to get it over there, let alone cross over. So I think that's a lot of work to be done. You've just made a little bit of a V-shaped pattern in the on-balance volume. That is good. The stochastic has turned up and is just at the end of the day it crossed positively. That's good. But the stochastic's still only at 8.83%. That's a lot of work to do to get to the 20+% where you're at least in some kind of a trend in the stochastic. So to answer your question, I'm anticipating, and this is what I drew yesterday in the ESH5 when I had a call. I drew this arch formation in, and it said the area of 2069.50, the 9-period exponential moving average, that black line there. Let me just open it up and we can talk about it with a little more clarity. Right there says that should be some kind of reversal, probably strong reversal, but I'm thinking that the 200 period smooth moving average, which comes in at 2000, and I think that's correct. Am I correct here? I've got so many lines now. I keep them there. 2075. Well, 2075 is still another 16 points to the upside in the S&P. It's about 130 to 150 points in the Dow. I'm looking at it and I'm saying, that let me now pull out the this particular chart, and it shows you 2077 is the level on my automated technical tool, resistance support level chart on the March E-mini, and that says 2077. So I'm expecting that if there is a rally, the real evidence of what's going on is going to be, there are a number of little areas that I'm looking at, including the VIX index. You asked about the 9 EMA. Today we touched the 9 EMA so far. The high today is 2068.75, and 2069 is the 9 EMA resistance. I'm anticipating that after a move like yesterday, we've got something like the same pattern on the way down. I call it the sandwich pattern. You got the strong down move, you got an inside bar, strong down move, inside bar, strong down move, and then a little candle, and then a strong bar. I think this is the day that we get some kind of a doji type candle, and the real test comes Monday. And what would that mean? That would mean whatever the high is today in the S&P cash or the E-mini, let's go to the cash because that was your question, SPXX. Whatever the high is today, if we close above it on Monday, you can expect another bounce on Tuesday, but then a pullback on Tuesday. That's where the evidence is to say, am I correct in anticipating that we got another arch formation with a retest of the recent lows? Or is this the start of a move that's going to be like this here? This is what I showed my subscribers for my opening call. This is the Dow chart that I show every single day. And what it shows is in the Dow chart, you could make a case that there's a little mini up channel that started here. There is resistance, that thick brownish dashed line says that the resistance in the Dow today should be around about 17,916, somewhere around 920s, and that the support would be the dashed line right there, and the support should be 17,820 to 17,720 in the Dow itself. So all I can answer you to be without trying to be a seer, without trying to extrapolate too much information, is that for me, the technicals are still way too weak in the daily chart. It's going to take let me move this up, it's going to take the S&P 120-minute chart, which is actually only in leg B right now, with tremendous resistance at the 200-period moving average of 2,069.50, and how we can close above it for two 120-minute bars above this 200-period moving average is going to be really important, because the technicals in the 120-minute chart are good. They're not great, but they are good, and they are confirming the rally so far. So the most important thing for me is this. Let me give you the figures. It is 2069 to 2071 resistance on the upside. That corresponds to the 2073 9-period moving average in the S&P in the daily chart. And the support says if the S&P, for whatever reason, takes out 2059 to 2058, that will say that yesterday's rally was mostly short covering, plus some new buying, but not enough new buying yet to support a sustained move. Well, that was a long way of saying I think the upside is limited right now. Let's see what happens.
Basil, thank you for that very thorough discussion. That's my mallard duck. If you wouldn't mind addressing one last, my golden-eyed duck on the composite index, the NASDAQ composite, I'd appreciate it.
Absolutely. That's why I'm here. So let's go to the composite, folks. We're looking at... Thank you. I just want to mention, thank you for bringing that up, because part of the other pieces of the puzzle that I said were there, I don't know if I even would have got into it. I would have got into it in my show, but I'll do it now, is to say that yesterday's action in the composite and yesterday's action in the QQQ series was terrible. It was nothing. Look at the 200-period moving average. It just held it in the 120-minute chart, and it failed to really spring higher. It's going to make today's action in the NASDAQ really important. And now, your question.
So here's my question on the composite. First, a statement. The Chapman wave counts for for COMP, the NASDAQ Composite Index, which made a high at 5,008 on March 2nd. Your Chapman wave count on the daily is peak D. Your Chapman count on the weekly is peak G/C. And in the monthly, you're in leg F/B. Now,
correct, yes.
My question. With all those factors stated and the action that has occurred March 2nd into the low Wednesday, the 11th.
Yep.
Does your work suggest strongly a decline to test the January lows near 4,600 or the October lows down at 4,100?
Can I bring something up? I know you've just asked me about the comp index, but something that I discussed a while back, and one of the reasons why I don't believe we're going to take out the October low at any point soon is this. In my work over the years, I use volume, I use on-balance volume, and I always look at volume, but I don't really use it. We have people at TFNN, we have hosts, we have Tom O'Brien. They are masters of the volume area. I happen to have found in my own work that for my particular technique, volume is really just another tool. It has no importance until I need it. That's just, everybody has their own techniques. That's just my technique. But one of the ways I learned over the years to use volume is what I call a volume. Well, let me just get this chart fixed up here, right there. A volume climax low. It's a volume price climax. And what that says is every once in a while, you get so much selling, so intense a selling, that there is a slide to the bottom that reverses as if everyone was throwing everything out, the baby in the bathwater. It creates a low of such importance with a volume spike that is generated that is greater than any volume that you've had before. And I'm showing this particular volume right here, 11.7 million. Right there on the week of October the 10th. And I'll talk about that can you hold on?
Yes, I can.
Great. We'll be back. We're talking with John in Philly. I'll be right back.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open, even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Catch Steve Rhodes as he teaches techniques on technical analysis using pattern recognition, celestial charting, Fibonacci, and other tools. The Trader's Edge, next on TFNN.
Hi, everyone. We are back. This is Basil Chapman sitting in for John Logan. John's in transit, and right now we're talking with John in Philly. We're talking about a number of factors. We spoke about the 9-period exponential moving average. We spoke about the daily chart, the weekly chart, the monthly chart of the S&P, as well as others. And John asked me about the comp index. That is the very broad composite index on the Nasdaq Composite Index, which was once upon a time called the over-the-counter, the OTC. But what I've been talking about is the volume climactic low in the S&P back on October the 15th. And what that does for me, it says, now I usually use it in dailies. Occasionally I'll use it in a weekly chart, but it takes so long for it to unfold. It's like a half a year to a year that I use it only as a guide in the weekly, but I use it emphatically in the daily as something that is very pertinent to my work. And what is the rule that I've developed? It says that when you make a climactic low bar, you should take 28 bars, and that's where it tests within 28 bars, you should not take out the low that was made, in this case 1820.66. That's number one. And number two, if in fact you make higher highs and you're starting to make higher lows, you can go for 52 weeks. That's not double the 28. I don't know, and don't even ask me how I came up with those numbers. I did a lot of work to come up with the numbers. I cannot recall exactly why those, but those are the numbers that have stuck with me. They seem to have worked. We looked at that once upon a time when the XAU made a low, or gold made a low, and I said that it should move higher for at least 28 days, and then move, and otherwise it can go to 50-something days. So in this particular instance, we're only at the 21st week, and we're making higher highs and higher lows. It says to me that there's a really good chance that in a worst-case situation, we can go down toward the 1820 level, but we will not take it out, not for another 21, not for another 7 weeks, at least in this methodology at this particular time. So did I answer some part of the questions?
Yes. Yes, indeed. Thank you.
So the only aspect that I wanted to mention to you, since you brought up the composite index, is that I do want to just get it out there. I can't remember if I mentioned it yesterday or not. But I'm very satisfied with calling the Phantom Peak, the Chapman, I should even write it in, but I've got it in color right there. That red C is what I call a Phantom Peak. It did not make a lower high bar. The high was 4989.11 on the 26 in the composite index, and it was at 4989.25, 14 cents higher on the 27th, and then we went to the leg D, peak D on the 2nd of March. That should be a peak C, but I'm using that as a phantom peak. Why? Because the QQQ series, 1, 2, 3, went to 109.42 at a perfect peak D, because that did make a peak at 108.94 on the 26th of February. And on the 27th of February, it was 108.91, 3 cents lower. That makes a peak, and then it goes to leg D and peak D. So I hope that in many ways has covered a chunk of what you've called about. Always appreciate insightful questions that you have, whether it's me or any of the other hosts that you ask these questions of. John, thank you very much for being there, and TFNN really appreciates your kind of questioning and devotion to TFNN itself. Thank you.
Appreciate your help, Basil. Bye now.
Thank you very much. So, folks, we're about to break, and we're going to go over to, I believe it's Tom O'Brien going to be taking it over while Steve is away. I'll be back at 11 o'clock for the Tiger Technicians Hour. Thank you for being here. If you want to check out my work this weekend, it'll be perfect. It is the opening call. You get a trial subscription, and I will be, and Tom O'Brien right here coming into the Bull Bear Binary Option Hour as well. I'll be back at 11 o'clock.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.